Welcome to the ultimate trading strategy compilation. Get ready to get your mind blown by a combination of strategies which we have been presenting in the previous few videos. This video brings together powerful insights, proven setups, and expert tips all in one place. Let's dive in and level up your trading game. Which trader does not want to trade explosive bull moves in the market? Whether it is in stocks, equities, commodities or cryptocurrencies, traders are always on the lookout for such explosive moves. In this video, we disclose one such methodology of catching such explosive moves. It is one of the best hidden secrets by high net worth individuals and by high-end traders who trade such explosive moves on a regular basis. The indicator which we are talking about is called the Williams percentage R oscillator. It was formulated in the 1970s by one of the most renowned traders in the world, Larry Williams. Please watch till the end of this video where we will give you a system to catch and trade such explosive moves in the market. The Williams R is a momentum oscillator and it has a very basic formula. Normally calculated over 14 days, it is the current close of any candle minus the highest high in 14 days divided by the range in the 14 days. Now, based on this definition, it is clear that the Williams R is the inverse of the fast stochastic oscillator formulated by George Lane and which forms the basis of the stochastic oscillator, which is one of the most widely used momentum indicators in the world today. Basically, therefore, the Williams R is a marker of where the current price is in the high-low range of a certain number of days. If price is tightly compressed, then even a small change in price can result in a large change in the indicator. One of the reasons for this happening is that the indicator is basically a raw line and not a slowed line with any moving average. Another advantage of the Williams R is that it can be also used on other market parameters like the volume, and a comparison of the movement of the Williams R on price and volume can yield interesting results. However, these are topics which are not related to our current objective, which is to use the Williams R to determine explosive moves in the market. It is available on all charting and trading platforms, and here is an example of how it is plotted. Here you can see the chart of Nifty futures. Now, in order to plot the Williams R, I add indicator, come to Williams R, and I plot it over 14 days. Now, when I do that, it plots a single line. That is how simple it is. The only difference you will notice is that the range of the Williams R is from 0 to minus 100, unlike the RSI and the stochastic oscillator, where the range is from 0 to plus 100. Now, the Williams R is a phenomenal indicator to catch explosive moves when it drops below minus 90, indicating a deep panic, and then rapidly snaps back above minus 50. This bounce in the Williams R, which is corroborated by a bounce in the stock, is not just a bounce. It is a momentum ignition. And this setup is called a whiplash setup. The Williams R breaking below minus 90, then within 5 candles of this break, spiking above minus 50. Volume may or may not confirm the trend. If it does, very good. But if it does not, it is not a deal breaker. The whiplash setup precedes strong reversals and explosive trend legs. By the way, if you're finding this helpful, we have just launched our live technical analysis course on www.chartinfo.org. If you want to understand how to analyze a chart perfectly and convert an analysis into a profitable trade and actually apply what you're learning to the markets, this would be an ideal course for you. We cover everything from price action trading and indicators to trading methods and systems in our own unique way. And it's all interactive, so you can clarify doubts in each class. Definitely check it out at the website if you're ready to level up. Now back to the video. It is best used on the daily time frame with a vision of holding trades for a longer period of time with patience, with a risk reward of no less than 1:5. The reverse move in the Williams R is also possible, with it going above -10 and then dropping below -50. However, there are better indicators and better chart patterns like the head and shoulders or the descending triangle, which are available for catching such steep falls and crashes. Therefore, the bull side of the Williams R will only be discussed because it is far more reliable and far more adaptive to the retail trader who is looking for bull moves rather than bear moves. Now, momentum in the Williams R is not just a technical parameter, it is a capture of the intensity of emotion. Some traders actually go to the extent of saying that they feel the Williams R more than they read it. And the Williams R has the uncanny ability of moving one day ahead of the actual price move. So there is something uncanny and something metaphysical about this indicator. The trading system, the Pine 6 code of which is given in our description, is as follows for buy moves only. For stocks, if the Williams R spikes below -90 and then within 5 candles breaks out above -50, buy on the open of the next candle, keeping a stop loss of 2% below the low of the previous candle with a target of at least a 10% move from the entry. Now, you may keep a trailing stop loss based on ATR as per your comfort level in order to get a profit protection in case we do not meet the full target. For indices, the numbers will become a 1% stop loss and a 5% target, since 2% and 10% are very large numbers in the case of indices. Now, three examples of such moves. The first example is in the bank nifty. The green arrows represent the system outputs. As you can see, all the trades are correct and are giving you phenomenal risk reward ratios. The second example is in REC, where again the moves are phenomenal and every single trade is correct. Some trades may not give you the desired output, but that is where your trailing stop loss will come into play. The third example is in Adani Enterprises, where again you can see the size of the moves which this system gives. Now, the majority of the trades taken out of this system will be explosive buys, provided that you hold them with patience and discipline. Now, majority does not mean every trade, but it does mean that most of the trades in this system will work with great precision. Please consult with your professional portfolio manager before actually putting in a trade, keeping in mind that this is an educational channel. One of the things which I would like you to do is sit down in case you don't lose your balance and apply this system in two stocks which have moved explosively currently, R Power and Rel Infra. You will be shocked at the magnitude of the results in these two systems. The Bollinger Band is a powerful technical indicator formulated by John Bollinger around 1980s. The band consists of three lines, the middle line being a moving average and the above and below line being connected to the moving average by an indicator called the standard deviation. Now, the middle line is generally a 20-day simple moving average, and the top and bottom bands are two standard deviations away from the middle line. The distance between the top and bottom lines is called the bandwidth. I will be showing you this indicator shortly when this concept will become clearer. So here is a chart of the Nifty futures of the current month. And I'm now going to plot the Bollinger Band on this by going to the indicator window and going to Bollinger Band. So it is a 20 time period Bollinger Band with the up and down deviations being two standard deviations from the mean. This is what the Bollinger Band looks like. Moving on, let us understand the concept of the standard deviation. So the standard deviation measures how spread numbers are in a data set. In other words, how spread apart are the closing prices of a given stock or an asset. So it shows the average distance of each data point from the mean, which is the moving average. And basically, a low standard deviation means that the closing prices are close to the mean. In other words, they are constricted. So we are in a low volatility period as compared to a high standard deviation where the lines are spread out, the prices are spread out, and therefore we are in a high volatility scenario. So it is commonly used in statistics, finance, and quality control. Now, normally, if a stock price is at 100 rupees and it has an annualized standard deviation or an annualized volatility of 10%, then we can use this to estimate the expected range of the price over a year. Based on basic statistical theory, we can say that the price will be 10% lower than 100 or 10% higher than 100, that is 90 to 110, with a 68% confidence interval. So this essentially represents one standard deviation. If we go to two standard deviations, then it will be 100 plus or minus 20%, which will be 80 to 120. And this we can say with a 95% confidence level. Three standard deviation would mean 100 plus minus 30, which is 70 to 130, which is a 99.7% confidence level. Since 95% is considered enough for all practical cases, two standard deviations are used, and therefore John Bollinger used two standard deviations away from the mean to calculate the bands of the Bollinger Band. Moving on to the usage of the band. The band essentially, as I told you, consists of a moving average with a top line and a bottom line. The distance between the two is called the bandwidth. Now, when the market is volatile, the bands widen. When the market is calm or in a trading range, they contract. So basically, the widening and the contraction of the band helps traders to spot shifts in momentum and potential breakouts. Remember that if a widening band shows inclination of becoming thinner, this is a sign that we may be moving from a trending market to a trading range market, and vice versa. So this could also be used for buying and selling options. Buying options is normally done in a trending market, while selling options is normally done in a trading range market, in order to ensure that the time value is not offset by the price movement of the stock. Now, coming to the next point, when price touches the upper band, a lot of traders think it might be overbought. And when it touches the lower band, they think it might be oversold. But the word overbought and oversold are not valid in all markets. They are valid only in a trading range market. And it is only in a trading range market that signs of mean reversion may occur, which is why the top of the band may be considered as overbought and the bottom may be considered as oversold only if we are in a trading range market. In a trending market, a breakout from the band will give us a trading signal. So the Bollinger Band is a trading tool, and a breakout from the top of the band gives us a buy signal, from the bottom of the band gives us a sell signal. In a trending market, a band breakout can therefore signal strength and continuation. Now, John Bollinger said that if prices exit the band, then buy, and if prices go below the band, sell. This can lead to a bit of confusion if we look at actual charts. By the way, if you're finding this helpful, we have just launched a live technical analysis course on www.chartinfo.org. If you want to understand how to analyze a chart perfectly and convert an analysis into a profitable trade and actually apply what you're learning to the markets, this would be an ideal course for you. We cover everything from price action trading and indicators to trading methods and systems in our own unique way. And it's all interactive, so you can clarify doubts in each class. Definitely check it out at the website if you're ready to level up. Now back to the video. Now here, if you look at the Bollinger Band, which I've drawn on the chart of the Nifty, you can see that if I use the normal Bollinger Band as formulated by John Bollinger, where are you finding that the prices are exiting the band? The reason why prices are not exiting the band is that When prices start moving, the band, which is based on a moving average of the prices, also starts moving with the band. So this is equivalent to your sitting inside a plane which is completely isolated from the outside world. Whether the plane is on the ground or whether it is taking off will not be known to you unless you have a reference point. When we sit in a plane, we know that we are taking off. When we look outside, we see that the ground is moving away from us. Now, if I take the normal Bollinger Band and offset it by half the time period of the moving average, in this case 10 periods, then essentially what I'm doing is I'm catching the band and pulling it forward so that previous values of the band, which were an earlier reference, are now above the current value of the prices. If you look at the chart in front of you, you will see how clearly a buy signal came here as compared to no signal coming here. This is an offset Bollinger Band, whereas this is a normal Bollinger Band. Again, take a look at another example where here we had a huge downfall and the band kept staying with the prices without giving you any definitive or concrete signal. If I offset the band by 10 periods, then previous values of the band come above or below the current value of the prices, and look at the clarity with which you got a sell signal. So here is something fantastic which you can use, which is an offset Bollinger Band. An offset Bollinger Band will give you crystal clear trading signals. When we exit the offset band in either direction, a trade is to be initiated the next day. If we break upwards, we buy at the opening of the next candle, keeping the lowest low of the last three candles as the stop loss. If we break downwards, we short at the opening of the next candle, keeping the high of the last three candles as the stop loss. The target is to be determined either by a Fibonacci retracement or a Fibonacci projection, depending on as the case may be, or by the top of the band without an offset where a reversal pattern occurs. This is the method of trading with a Bollinger Band which is offset. Here is the Pine code for plotting an offset Bollinger Band in TradingView. The same has been given in our description below, and you may copy and paste this into TradingView for plotting the same. Another way of using the band would be to use it as a dynamic overbought oversold level in momentum oscillators. Momentum oscillators like the RSI have a fixed overbought and oversold level 70 and 30. Many a time we find that the value of the RSI changes its direction, especially in a trading range, much above 30 or much below 70. If instead of using the static bands, I use a dynamic band by plotting a Bollinger Band on the indicator, look at the accuracy with which overbought and oversold levels were caught. Here we were in a trading range. Look at how the bottom of the oscillators tallied with the bottom of the market. So basically, the Bollinger Band can be used as a dynamic overbought oversold indicator for momentum oscillators. The first thing that will go through your mind when you see this video is that, oh God, not another moving average video. And let me tell you, the last thing which will go through your mind after you have finished seeing this video is, thank God I saw this video. So today we are going to introduce you to a fantastic moving average, which is probably one of the best moving averages. Let us begin with understanding what is a moving average. A moving average is a body of data which is averaged and which moves forward with time. It is generally calculated on time series data, such as closing prices of a stock. Moving averages are confirmatory and not predictive tools. Since old data is used in the calculation of a moving averages are lagging tools. They lag behind the current data. Why? Because old data has come into the calculation of the moving average. Normally, they are used for trend confirmation. If prices are pulling away from a moving average, the asset is trending. if they are clustered around a moving average, the asset is in a trading range. The lag of a moving average is the bane of the moving average. It is the negative point of a moving average. And major attempts have been made by people all around the world to reduce the lag so that moving averages can follow the movement of the prices as accurately as possible. Now, what is a trend? A trend evolves when masses of traders in a crowd become convinced about a singular direction of the market. So we have an uptrend if masses of traders become bullish, a downtrend if masses of traders become bearish, and a trading range or a sideways market if they are confused. So a moving average is a trending market tool. It cannot be used in a trading range because the sideways market will give you too many erroneous signals if you use a moving average. What is the most important signal from a moving average? It is the slope of the moving average. If it is upward sloping, then it is an uptrend. If it is downward sloping, it is a downtrend. And the relative positioning of the price with respect to the moving average tells you whether the market is stronger than before or weaker than before. A crossover of prices from below a moving average to above a moving average signals a buy, and a crossover of prices from above a moving average to below a moving average signals a sell. Also, short term moving averages to long term moving average crossovers also give you similar signals. The most robust automated trading systems based on technical analysis are based on moving averages. You have other kind of algorithmic systems like order flow and statistical and so on, but technical analysis based algorithmic systems use moving average as the most robust base. So the moving average has to have a time period associated with it. Normally the time period is ranging from 5 periods to 200 periods. However, the moving average for short to medium term swing trading is ideally the 13 period moving average. An extremely important experience based advice which I'm giving you is do not use moving averages on time frames which are less than hourly. You can use it on 5 minutes, 15 minutes, 30 minutes. Nobody is going to stop you. However, my genuine advice to you would be to use moving averages on a minimum of an hourly time frame upwards. The reason being that the moment you go to lower time frames, movements of the market become more random, and therefore whipsaws, which are erroneous signals from moving averages, will increase in number. Therefore, it is better to use moving averages on a minimum of an hourly upwards, hourly, daily, weekly, and so on. The moving average, which I want to familiarize you with today, has greatly reduced the lag from the conventional moving averages of simple and exponential. These are the two moving averages which 99% of traders use all over the world. The moving average, which I discussed today, is based on a proprietary moving average called the Zurich moving average, which is, as I told you, proprietary and therefore not available for use unless you purchase it. However, this methodology, which I'm going to familiarize you with today, simulates using a certain amount of guesswork a version of the Zurich moving average. So let us call this moving average X, which is based on the ATR, which is the average true range over a period of time, which is a proxy for volatility and is therefore adaptive in nature. In faster moving markets, it will automatically adapt itself. In slower moving markets, it will automatically adapt itself. And the second thing which it uses is the DEMA, or the double exponential moving average, which was formulated by Patrick Mulloy in 1994, which incorporates very fast reactivity, low lag, and high smoothness due to its methodology of calculation. Since X is using lag reducing mathematics and is really fast with low lag, it opens itself up to rapidly changing and misbehaving in a trading range market. So that's like sitting in a very fast car and feeling uncomfortable with the speed. So what do we do to make the lag comfortable? We introduce another mathematical tool, which is a simulated Kalman filter. It was formulated by a person called Rudolf Kalman in 1960. We will call the Kalman filter, which is a simulated version of the original. Why? This is a powerful mathematical algorithm which is used to estimate the state of a dynamic system from a series of incomplete and noisy measurements. The Kalman filter, therefore, continuously predicts and corrects estimates over time, making it ideal for real time tracking and forecasting. Now, once we calculate X, which is extremely fast, and Y, which is noise reducing, we average the two to find the median of speed and reliability, which is X plus Y divided by 2. This is what I call fast adaptive signal tracking. Remember, moving averages attempt to attenuate the noise and amplify the signal. So, if I now show you the comparison of a 13 period fast with a 13 period exponential moving average and a 13 period simple moving average, you will see its power automatically. The proof of the pudding is in the eating. You may plot this on any chart of your choice and compare it with the EMA and the SMA. If you are convinced of its usage, then please consult a professional and registered portfolio manager to assist you with your trades. The source code of this fast moving average is given in the description of this video, which you can copy and paste in TradingView and use it. If you find it useful, go ahead and start using it. Here are two examples, one on an hourly chart, one on a daily chart of fast as compared to EMA and SMA. On the hourly chart, I show you the Nifty. This red line is fast. The blue line is the exponential moving average, and the green line is the simple moving average. You can see how quickly the fast responds to changes in the direction of the price. A second example is on the daily chart of the Nifty, which will show you a similar result, showing you that fast is superior to the exponential moving average and the simple moving average. You are free to adjust the parameters in fast, since you have the source code, to suit your trading style. The internet is replete with videos of people claiming to have the best and perfect system. Because no such thing exists in the arena of technical analysis, in this channel we make no such claim and present only systems which have a high probability of winning, one of which we are going to be presenting today. Today we present to you a method of catching massive breakouts before the crowd does with a simple tool, the Heikin Ashi candlesticks. Heikin Ashi candlesticks are a derived candlestick to identify strong trend continuations from a trading range. Most of us are now tired of false breakouts and choppy trends killing our trades. So today we are going to learn how to spot clean explosive breakouts in stocks. The strategy discussed in the latter part of this video filters out noise in the markets and helps you ride the big moves with confidence. So please watch the full video to take advantage of the system. Heikin Ashi means average bar in Japanese. It is a unique style of candlesticks that smooths price data. It was formulated in Japan by Monehisha Honma. Unlike regular candles which plot real market data, Heikin Ashi calculates and plots open, high, low, close differently. The open is defined as the open of the previous candle plus the close of the previous candle divided by 2. The close is the open, high, low, close divided by 4. With the new open and close calculated, the high is the maximum of high, open and close, whichever is the highest, and the low is the minimum of low, open and close, whichever is the lowest. Fortunately, we do not have to do this calculation. This is all done by the computer automatically. Now, this definition essentially ensures that the candles are averaged and smoother in appearance, since they track a price range rather than every price movement as regular candlesticks do. This results in candles that stay red during downtrends and green during uptrends, thereby filtering out market noise. Here is a chart of Nifty futures with normal candlesticks. To convert it to Heikin Ashi, I click on the Heikin Ashi bar, which is there in almost all trading platforms, and you can see that the candles have changed according to the calculation. You will notice that in a downtrend, the candles are uniformly black, and in uptrend, uniformly white. So, Heikin Ashi candles latch on to a color in a particular trend and hang on to that color till the trend reverses. Traders should memorize the three types of candles that exist in Heikin Ashi charts. Bullish candles are Heikin Ashi candles with big bodies and long upper shadows but no lower shadow. Bearish candles are Heikin Ashi candles with big bodies and long lower shadows but no upper shadow. Whereas reversal candles are Heikin Ashi candles that look like dojis. They have no or very small bodies but no upper or lower shadows. Heikin Ashi candlesticks must be used with caution with regards to the actual price, as the body doesn't necessarily sync up with the actual open close, since Heikin Ashi are theoretically calculated while regular candlesticks are real data. Unlike with regular candlesticks, a long wick in a Heikin Ashi shows more strength, whereas in the same period on a standard candlestick chart, it might show up as a long body with no wick. So when analyzing, we use Heikin Ashi, but when trading, we switch to regular candles and use the one which corresponded to the one on the Heikin Ashi chart. It has been proven that Heikin Ashi charts have a lower entropy or chaos than regular charts because they are smoothed and therefore have a higher probability of success than regular candlesticks. On the other hand, the disadvantage is that price gaps are missing on Heikin Ashi charts, and therefore regular candles must be used in conjunction with Heikin Ashi candles. However, chart patterns like the symmetrical ascending or descending triangles can be drawn on Heikin Ashi charts. By the way, if you are finding this helpful, we have just launched our live technical analysis course on www.chartinfo.org. If you want to understand how to analyze a chart perfectly and convert an analysis into a profitable trade and actually apply what you're learning to the markets, this would be an ideal course for you. We cover everything from price action trading and indicators to trading methods and systems in our own unique way. And it's all interactive, so you can clarify doubts in each class. Definitely check it out at the website if you're ready to level up. Now back to the video. We now examine the system which is going to give us the big breakouts based on the Heikin Ashi methodology. Here is a chart of the Nifty futures with regular candles. The first thing we do is we draw a horizontal line marking out an area of strong resistance beyond which the market could not go multiple times, like in this case where we have double tops. Also, we draw the Fibonacci retracement of the last swing. The reason for doing this is that we need to combine or confluence multiple resistance levels into one solid, powerful resistance level, which needs to be crossed by a powerful Heikin Ashi candle having a large body and no lower wick. This must be confirmed by a price pattern on the real price chart, like a gap or a chart pattern. Moreover, an analytical tool like a moving average needs to be put into place, which is sloping upwards and which has been crossed by the actual price chart to confirm the actual breakout in the prices. So now we determine that the red zone enclosed within the rectangle is a supply zone, and crossing it will give us the next leg of the move. If I now convert this into the Heikin Ashi charts, I see that the breakout has taken place with a large white candle having no lower shadow and a reasonably average upper shadow. This indicates a very high momentum in the breakout, indicating that there is going to be a further up move. Now that we know that we have got the breakout, we certify this with the value zone exponential moving average, the 50 period exponential moving average. Plotting this, the 50 period exponential moving average, we find that yes, indeed, the prices have crossed that region and are now squarely in the hands of bulls. This gives us a further confidence that the breakout is genuine and is going to take us to newer territory in terms of bullishness. We trade by going back to our original chart because that contains the actual open high low close, buying at the open of the candle next to the breakout candle, keeping the low of the breakout range as the stop loss, and keeping a risk reward ratio of 1:3, which automatically gives us a target. With this methodology, we will be able to catch high quality breakouts and breakdowns in the market using the Heikin Ashi charts in conjunction with actual price charts. A few things to be kept in mind while trading Heikin Ashi charts is: avoid trading during low volume sessions, use higher time frames like hourly or daily charts, always set a stop loss because every breakout or breakdown can fail, and over time you will develop a feel for the cleanest setups. Topic of discussion today is trading explosive moves with the slow stochastic. We discuss a powerful, lesser known hidden trading trick using the slow stochastic oscillator to catch big breakouts from a trading range after a strong uptrend in terms of a continuation move. Market momentum refers to the strength and power of price movements in a market, indicating how quickly prices are changing and whether a trend is likely to continue or fizzle out. It is essentially the speed of price changes, with higher momentum suggesting a sustained, more stronger trend. Momentum indicators measure this speed, and oscillators are a special category of momentum indicators which move in a predefined range, normally between 0 to 100. The slow stochastic is a momentum oscillator comparing a closing price to its price range over a period, normally 14 periods. The slow stochastic oscillator was developed by George Lane, the king of stochastics, in the 1950s. It is a smoothed version of the fast stochastic, which is a raw line in order to filter out spurious noises. Like all momentum oscillators, the slow stochastic is a leading indicator as opposed to moving averages and other indicators which are lagging indicators. That is, it inherently moves ahead of the price, but it must be traded only on price confirmation. If you visualize a rocket going up in the air, before it can turn down, it must slow down. Momentum always changes direction before price. It precedes the price changes. As prices move up, the close of the day has a tendency to crowd around the upper portion of the day's range. Just before we get the absolute price high, the market does not have as much energy as it did earlier. Therefore, the closes no longer crowd at the top of the daily range. The stochastics therefore turns down at or before the final price low. This is the case of the stochastics overbought being used as a reversal indicator. Overbought does not mean that too much buying has taken place. It is a technical term indicating that the oscillator has gone up too much and must now reverse. The condition for oversold is the exact reverse of what I've just described. There is an alternative scenario where strong bullish momentum has caused the oscillator to become overbought. But instead of reversing, the prices start cruising in a trading range, waiting for the next breakout as per Dow theory. All this while, the oscillator will remain overbought. A plot of the stochastic oscillator on the chart of Nifty futures on an hourly time frame would show up like this. We plot a 1455 stochastic oscillator, and you can see two lines which are oscillating between 0 and 100. One is the percentage K line, which is the main line derived from the raw line by smoothing. The percentage D line is the second line. It is a double smoothed signal line. Traditionally, Above 80 on the stochastic oscillator means that the upward momentum is extremely high and unsustainable, and so the oscillator and the price must reverse. Below 20 means that the downward momentum is extremely high and unsustainable, and so the oscillator and price must reverse. Most traders look at the stochastic oscillator to fade moves, selling when it is overbought and buying when it is oversold. There is nothing wrong with that, since this works very well when traded with strict discipline. However, the stochastic oscillator can do much more than simply show overbought and oversolds for reversals. In fact, there is a way to flip this logic and actually catch explosive continuation moves before they launch. Continuation moves are much more comfortable to trade than reversal moves because the mindset of the trader is adjusted to the current trend. So when the slow stochastic gets stuck in overbought territory and refuses to come down, it is actually a sign of a very powerful underlying bullish momentum and not exhaustion. This mega overbought condition is called stochastic embedding, and this is where explosive moves begin. The conditions for this are both percentage K and percentage D must be stuck above 85, which is a little more than conventional, for at least 5 candles. And this is based on the hourly time frame. Prices should be consolidating in a tight range, maybe in a small flag or a small pennant or a small rectangle. The entry trigger for this setup is when prices break above the consolidation range, while the stochastic oscillator remains embedded in its overbought condition. The longer the stochastic stays embedded, the stronger is the potential breakout. If confirmed with volume expansion, the conviction is higher. The entry is at the open of the bar following the breakout. The stop loss is below the consolidation low and the risk reward is at least 1:3. This automatically sets the target based on the stop loss. The stop loss must be trailed based on the ATR methodology. So we should not automatically sell just because the stochastic is overbought. In fact, we should look for price action like chart patterns to confirm the overbought oversold signals in all cases, reversal or consolidation. The key to winning in the market is to trade smart and stay consistent. The Pine 6 code for the hourly time frame is given in the comments. Based on our optimization, the parameters for the stochastic are 1455. The embedding bars are 5 and the overbought and oversold levels which we have selected are 85 and 10. The parameters have been altered to give optimum results. This system gives you both reversal and continuation signals on the slow stochastic. So that's a great bonus. Since this is an indicator-based system, it is not easy to generate precision good signals or eliminate bad ones. The system which has been programmed has given reasonably good trades. Indicator-based systems are best traded by actually looking at the chart and taking a call on what to do in the market. Therefore, indicator-based systems must be traded on price confirmation with a strict stop loss and with great discipline. Here are the examples of randomly selected stocks which have given signals based on this system. These are all based on futures charts on the hourly time frame. So we begin with the chart of Aarti Industries. You can see that this is definitely a reversal signal. This is a continuation signal. This here again is a reversal signal. The next chart is that of AU Bank. Here we have a series of signals which you can see have given reasonably good and sometimes exceptional trades. The third chart is of CDSL, which has given exceptional trades all along. And finally, we have a chart of Google where the trades are also quite good. We discussed today a bearish continuation pattern called the cat's ears pattern. Most technical analysts believe that continuation patterns are the most reliable and profitable. This is because the market has already established a trend And based on the principles of Dow theory, the most likely move is a continuation of the trend after a short rest in a trading range. Triangles, flags, and pennants are common continuation patterns in a trading range. A rare continuation pattern, which has recently been appearing quite frequently on current charts during downtrends, was discovered in 2012 by Georgios Siligardos of Greece and published in the Technical Analysis of Stocks and Commodities magazine. It has a well-defined entry, stop loss, and target, and is reliable and well suited for swing traders. It is called cat's ears due to its resemblance to cat's ears. This is a textbook representation of the pattern. Essentially, the market is in a downtrend and then goes into a trading range, followed by a jump, which quickly recedes again into a trading range. From this trading range, prices jump up again and recede, and then break this line here to continue the downtrend. These are the various phases of the cat's ears pattern. Please remember that while pattern hunting, do not look for exactness on the charts. Price patterns are manifested by the actions of human traders, and the action of humans are never exact, and neither are price patterns. With that said, we should attempt to fit even resemblances to the cat's ears into the framework of the structure of the cat's ears, which has just been described. The volume is usually low during the evolution of the cat's ears. Brief volume expansion may appear at the tops of the cat's left and right ears, and very low volume may appear during the formation of the cat's scalp. The break of the scalp line may take place with high volume, and any pullback attempt to the scalp line will usually occur on low volume. Also remember that even though all chart patterns have an association with volume and momentum indicators, these are not deal breakers if they are not occurring. Price movement is the primary concern in price patterns, which is why they are called price patterns. And all other indications are secondary and at best supportive in nature. The duration of the cat's ears pattern is generally 10 to 60 days, and it is best exploitable by bearish swing traders. The key thing is that in cat's ears, like all price patterns, the beauty of the pattern lies in the eyes of the beholder. And therefore, these patterns are best determined and traded with visual inspection. There are a lot of pattern determining programs, but they are no match for the human brain in discerning chart patterns. These are variations of the pattern. The left and right ears may not be exactly at the same level, and the scalp line may be slightly above or below, as shown. While the cat's ears pattern develops in a context of 6 phases, there may be cases where one or more phases may be absent. By the way, if you're finding this helpful, we have just launched our live technical analysis course on www.chartinfo.org. If you want to understand how to analyze a chart perfectly and convert an analysis into a profitable trade and actually apply what you're learning to the markets, this would be an ideal course for you. We cover everything from price action trading and indicators to trading methods and systems in our own unique way. And it's all interactive, so you can clarify doubts in each class. Definitely check it out at the website if you're ready to level up. Now back to the video. This is a practical example of the cat's ears pattern in Angel 1. The stock was in a strong downtrend and then made a cat's ears pattern, which ultimately met its target. Remember that the entry is at the breakage of the scalp line, the stop loss is just above the scalp line, and the target is the projected distance from the top of the pattern downwards from the scalp line. Our second example is in Apollo Hospitals, where again we were in a downtrend, made an almost perfect cat's ears, which quickly met its target upon breakage. Here, of course, the breakdown candle itself met the target, giving very little chance for the trader to react. A third example is on Axis Bank, where we have a downtrend followed by a cat's ears, and upon breakage, the target is met and doubled in course of its movement. This is one of the best cat's ears patterns which I've seen in recent times. Finally, here is a chart of Tesla with a variation of the cat's ears pattern. Here, the pattern broke and met its target quite easily. Incidentally, there is an aggressive way to trade the cat's ears. and that is to preempt or short circuit the right ear as an anticipatory cat's ears pattern, entering around the top region of the left ear when a reversal pattern appears around the same region of the anticipated right ear. The pattern, which could be a candlestick reversal or a gap, must be traded on the candle confirming the reversal, keeping the top of the cat's ears as the stop loss and a target equal to the move to the scalp line plus the projection as described earlier.